Many people have heard the story about Mark Cuban getting rich from selling his company to Yahoo. What most people don't know is how lucky he really was and how he almost lost it all a few months after closing the deal with Yahoo. This video will explain what happened and what you can learn from it. First, a little background on Mark Cuban. Mark was always an entrepreneur and was always looking for ways to make money and start businesses. He ran a successful bar during college, and after college he started Micro Solutions and ran it for 7 years before selling it to CompuServe for $6 million in 1990. This netted him about $2 million after taxes, and even though $2 million is nowhere near $1 billion, it was enough for Mark to never have to work again if he invested the money conservatively. Now, when I say Mark Cuban was lucky, I don't mean it in the sense that he was sitting on his couch all day watching TV and someone just knocked on his door and handed him $1 billion. No, he was lucky in the way of that saying that goes, "The harder I work, the luckier I get." So he was lucky in the sense that he saw the potential in broadcast.com right when all things internet was exploding and Yahoo had an inflated stock price and was looking to buy companies to stay ahead of the competing search engines. All this was at the time right before the massive internet bubble peaked. But even with all this lucky timing and favorable conditions, if he did not take the steps he did to protect his Yahoo stock, he would not be a billionaire from the broadcast.com deal today. After selling Micro Solutions, he traveled around the world for 5 years. He then came back, and Mark and a partner bought into a company called AudioNet. They renamed it broadcast.com, and on July 18th, 1998, their company went public. Their IPO was priced at $18 a share, but finished the day trading at $62.75, which was a gain of over 250%. This was also a new record for the first day trading of an IPO. So, was this huge demand for this stock because the company was making huge amounts of money? No, the company lost $16.4 million on just $22 million in sales in 1998. Yet, here it was with a valuation of $1 billion on its first day of trading. Now, Mark knew that this was a crazy valuation in a crazy market. He wrote about it years later when he talked about the roadshow for broadcast.com, where they pitched the IPO to investors who run mutual funds and pension funds, basically the people who invest your money. On the roadshow, they visited 63 companies and talked to about 400 people, and he said, "I would be exaggerating if I said we got 10 good questions about our business and how it worked." So these people knew nothing about the business, but yet they still placed the full allowable order for the shares just because they knew it was going to be hot because it was internet related. And he said, "When broadcast.com went public, we raised a lot of money. That certainly helped us grow as a company. But once you get past the raising capital part of the market, the stock market becomes not only inefficient, but as close to a Ponzi scheme as you can get." So I'm sure he realized that his company was overpriced and Yahoo stock was overpriced. And so just swapping his company for Yahoo stock doesn't really solve his problem of what happens if the internet bubble bursts. So this is what he did about it. So when he got the offer to sell his company for $5.7 billion on April 1st, 1999, just 9 months after going public, he jumped at the offer. This purchase by Yahoo is known as one of the worst deals ever made during the internet bubble. Broadcast.com still was not making a profit even though they had 570,000 users. Yahoo paid them a whopping $10,000 per user. Even so, Yahoo was paying for this overpriced company with their own overpriced stock. So Mark got 14.6 million shares of Yahoo when it was about $95 a share, which makes his stock worth about $1.4 billion. The problem is that the deal came with a 3-year lockup period where he couldn't sell the stock. Little did Mark or anyone know that Yahoo would peak in the next 8 months, and by the end of 1999, the internet bubble would pop. To see just how precarious Mark Cuban's wealth was being tied up in Yahoo stock during the internet bubble, let's take a look at the historical chart of Yahoo to see what was going on at the time. Now, Yahoo had a bunch of splits, so the actual pricing on this chart is different than the actual prices that it traded at because of the splits. So this is split adjusted chart. But you don't really need to know the exact numbers to look at what happened, okay? You see here, April 1st, 1999, Yahoo buys broadcast.com. So right around here. Okay, and of course these deals don't close immediately. They take a few months. I'm not sure exactly when the deal closed, so when Mark got his stock, but from the time the deal was announced to the time that Yahoo reached its all-time high was just 8 months, from April 1st to January 3rd, 2000. Okay, and that was a high price of 237, or on this chart split adjusted 118. Now, from that time, January 3rd, till it went right back to the original price when Yahoo acquired broadcast.com, was only somewhere in the late 2000s over here, maybe in September or so. And from the time that it reached its all-time high to the time that it reached its all-time low over here, where it fell to $8.11, or a 93% loss from the top, was September 26, 2001. So just a year and a half from here to the bottom. Okay, but even so, just right after the all-time high, it fell like a rock pretty quickly, along with the rest of the NASDAQ stocks and the internet bubble. Even the index, the QQQ, fell like 70% from its high. So really no internet stocks were immune, including Yahoo. And also you see that from the time Yahoo bought broadcast.com, April 1st, 1999, like I said, the deal doesn't close immediately, so maybe he got his stock somewhere around here. He had a 3-year lockup agreement where he couldn't sell any stock. So if he got his stock here, let's say, and had to hold it for 3 years, well, the bottom here, 2001, is not 3 years from here. It's only, 2 years, 2.5 years actually. So had he had to hold this whole time without selling any stock, he would have lost a good chunk, most of the value of his Yahoo stock. So that's the saving grace, that he did this collar to preserve his gains on this stock, because you see how volatile Yahoo was, and it proved to be, it proved to come down just as fast as it went up. So just like all the other internet stocks. I mean, even people like Jeff Bezos, saw his fortune fall probably 95% from its high in Amazon stock to its low. So nobody was immune, and most people really took a bath on their stocks. Very few people protected it, but Mark Cuban was one of the smart ones who actually did protect it and kept the majority of his gains. Okay, so let's see how Mark Cuban protected his Yahoo stock with a collar. If you don't know what options are, let me just explain real quick. An option is like an insurance policy. And just like if you have a car, you might buy insurance from Geico, right? Geico is the insurance seller, you're the insurance buyer. Well, in the stock market, you can choose to be Geico, or you could choose to be the car owner, or you could be both. So in this case, Mark Cuban was both the insurance buyer and the insurance seller, okay? And so the way a collar works is that it's just that, a collar, it kind of contains the price around a certain area, and anything that goes outside of that area, you're covered for, okay? So if you are buying a put option, you're expecting the market to go down or that price to go down. So you're buying insurance from the insurance company that if the price goes down, you're covered below a certain level. So in this case, he bought a put at $85, which means at the time he bought the collar, the price of Yahoo was $95. Okay, so he bought a put at $85, which means he has a potential $10 loss. Think of that like your deductible on your car insurance. Okay, if he has an accident, the most he could lose is $10. Anything below that, he's covered. So if he has all the stock at 95, 14.6 million shares, and the stock goes below $85, he's guaranteed to get $85 times 14.6 million. Okay, so that's, I don't know, 1.3 million or something like that. Okay, so he bought one put. Now the problem is that he has to buy 146,000 of these contracts, because each contract represents 100 shares of stock. So if he has 14.6 million shares, he has to buy 146,000 contracts. Now, if you know the options market, you know you cannot buy 146,000 contracts very easily, especially on options that are going out for 3 years. Okay, you may be able to buy a few thousand options on a contract that expires in a month, but for 3 years out, no way. And that's where a specialized company like Goldman Sachs comes in and makes a structured product for you, where they structure it so that you don't pay any money, meaning it costs you money to buy these puts, but you're also selling these calls. And what selling the calls does is, normally if you buy a call at 205, you're expecting the price to go above 205. And so let's say you pay $10 for each contract, you're expecting the price to go way over $215, because if you're paying $10 for each call, you have to wait until it goes above 215 for you to break even. So, but in this case, Mark Cuban was selling these calls. He was selling these calls to pay for the price of buying these puts. So he's selling these calls at 205 and buying these puts at 85, both going out for 3 years. So the premium, the insurance money he received for selling these equaled the amount he had to pay to insure this loss down here, the put at 85. So he didn't have to come out of his pocket for any money, okay? And so this is how it works. At $95, he buys this put. At 85, he sells this call at 205. Okay, if the stock goes within the next 3 years below $85, he'll lose $10 per share, but he'll be covered on the way down. Anything above $95, if the stock goes, he'll make $1, on his 14.6 million shares. Each dollar it goes up all the way up to 205. So let's say it went up to 205 and stopped there, and in 3 years he would have made $3 billion. Okay, but anything above that, he doesn't profit anymore. Okay, so whether it goes to 205 or 237, which was the all-time high, doesn't matter. It could go to 1,000, it still won't matter. All he'll get is his $205 per share. Same with the way down. On the way down, the stock could go to 0, he'll still get $85 a share. And so that's how he protected this stock that he had. Now, if you own this stock and you have $1.4 billion here at $95, I imagine how much sleep you get or don't get if you don't have this collar on. Or even if you do have the collar on, right? When it goes to $205 and above, you start saying, oh my God, every dollar above 205 is another $14.6 million that I'm giving away in profit. You know, when it goes to 237, you're like, that's another, you know, $32 times 14 million shares. It's, you know, $50 million that I just gave up. No, not 50 million, 500 million that I just gave up. So, you know, depending on where the price is, you may think you're a genius one day and an idiot the next day. But with this collar here, you could sleep at night knowing exactly what the maximum profit you'll make is and what the maximum loss you'll have is. And so with that, you can then plan your life and not worry about the ups and downs of the stock market or Yahoo in particular. So what are the lessons you can learn from what happened to Mark? Well, for one, to make really big money like this, you'll only get it from starting a business, especially one that can scale. So whether he had 500,000 users or 5 million users, it was pretty much the same infrastructure. It's not like a Starbucks where you have to open up 5,000 stores or something like that. So he was able to scale quickly and take advantage of the environment and get a really big payday, and luckily he was able to keep that. And that brings me to number 2, don't put your eggs in one basket. Even Warren Buffett says never bet the farm on any one idea. So no matter how good you think a company is, something can always go wrong, or the climate could change or something. So don't bet all of your wealth on just one company or one stock. And number 3 is that the old Wall Street saying is that trees don't grow to the sky. Okay, there's a limit to how tall a tree will get. So when everybody thinks a bull market will go on forever, it's usually the top, and it's a good idea to lighten up and take some chips off the table. So I hope you liked this video. If you did, leave a thumbs up and let me know in the comments if you think Mark was lucky or smart or some combination of both. Please subscribe to my channel if you haven't done so already. Thanks for watching.